I calculated that in about the last 4 years, 4 calendar years, something like 2,100 tons of gold had been stood for delivery. Now, of course, some of that may be between bullion banks. I mean, we really don't know the answer to this. But the other thing that we are seeing is that the managed money category on COMEX is having less of an influence on things. I mean, you've got a pretty low level of outstanding open interest. I mean, it's around about 417,000, which is pretty low, particularly when you see gold going up to new highs.
The global gold market experienced unprecedented disruption in 2024 and early 2025, driven by President Trump's tariff threats that fundamentally altered the traditional flow of precious metals between major financial centers. This extraordinary period, analyzed comprehensively by Alasdair Macleod, head of research at GoldMoney, revealed the hidden complexities and vulnerabilities within the international gold trading system. Macleod highlights the often overlooked scale of physical gold demand, noting around 1,500 tons are stood for delivery annually. Since Thanksgiving alone, 69 tons have been stood for delivery on COMEX, exceeding the gold reserves of many countries. The most dramatic manifestation of these market forces occurred between late March and late June 2024, when an extraordinary 800 to 850 tons of gold were physically relocated from storage facilities in London, Switzerland, and Mumbai to COMEX vaults in New York. This massive transfer, officially recorded at 732.51 tons, was primarily driven by powerful arbitrage opportunities that made such large-scale international movements economically compelling. The logistical operation involved established precious metals handlers, with Brink's and JP Chase receiving the majority of incoming shipments. However, as Macleod astutely observed, significant questions remain about the ultimate destination of this gold once withdrawn from COMEX facilities and the identities of the entities orchestrating these movements. Recent data shows that delivery levels, which since the May contract ran off the board, have totaled 21,825 contracts, or 67.89 tons, suggesting that the tonnage going out of the far larger London forward market similarly must be well into the hundreds. President Trump's announcement of potential 25% tariffs on imported goods served as the primary catalyst for this unprecedented gold migration. The tariff threat created immediate market panic about potential supply constraints and dramatically shifted risk perceptions across the precious metals sector. All existing slots at the Bank of England to withdraw gold bars became booked up as market players raced to ship the metal to the United States to take advantage of a surge in gold prices there. Before we begin, make sure to subscribe, hit the bell icon, and share this video with others who'd find it useful. Your support helps spread these important insights.
For quite a lot of people within the bullion bank system see gold coming back into the UK vaults. Now, I don't think that's quite right, because really the problem I think that the bullion banks had was that when Trump threatened 25% tariffs across the board, when he first got elected, they sort of thought, well, if gold is going to cost 25% more in America, we have got deliveries which we have got to make. We don't have the gold necessarily to cover it. And not only that, but we're going to have future deliveries. So you can see why there was this panic, if you like, to move over. And the one thing that nobody seems to watch are the stands for delivery. I mean, they are absolutely huge. The rate at which they're running this year so far is roughly 1,500 tons for the whole year, if you extrapolate what's happened so far into the whole year. And I mean, that's a lot of gold. And something like 850 tons, or something like that, was what moved over, if you like, into COMEX from London, Switzerland, and also places like Mumbai, believe it or not. I mean, so the arbitrage opportunity was so great. The problem is that we don't know who is actually standing for delivery. And gradually, as the stands for delivery occur, a lot of those people who stand for delivery withdraw it from the COMEX warehouse system. And that is now what we're beginning to see, because the level of stocks within COMEX warehouses is now beginning to decline. It's still very high, but it's beginning to decline. And this was something that happened after the spike. If you remember, at the time of COVID, later on that year, there was a similar situation where you had a spike, if you like, in gold going into COMEX. You had the premiums again on futures, which were driving it. And you ended up with far higher levels of gold bullion in the COMEX warehouse system. Gradually, after that happened, the level of gold in the warehouses actually diminished, and it went down and down and down until this recent spike up. And I calculated that in about the last 4 calendar years, something like 2,100 tons of gold had been stood for delivery. Now, of course, some of that may be between bullion banks. I mean, we really don't know the answer to this. But the other thing that we are seeing is that the managed money category on COMEX is having less of an influence on things. I mean, you've got a pretty low level of outstanding open interest. I mean, it's around about 417,000, which is pretty low, particularly when you see gold going up to new highs. And I think the other thing about this was that the rapid pace of gold going out of the Bank of England's vaults. Now, I mean, some of that, might have been, sort of, if you like, owned without future obligations, if I can put it that way, lease obligations, as it were, by commercial entities. But I'm sure that some of the gold that went out was probably leased gold. In other words, you see, when you lease gold, it becomes your property. If you're the lessor, it becomes your property until, under the terms of the lease, you return it. I mean, it's exactly the same like you go down to the local, sort of hardware place and you lease, say, a lawnmower to do your lawn. That is your property until you return it. Obviously, you've got to return it as you picked it up. Yeah, but it's your property legally at that point. And it's exactly the same with gold. So a lot of this gold, I think, went out. And of course, where's it gone? Can it actually come back? I mean, the answer, I think, is that most of it probably doesn't. Most of it's probably gone into interest, if you like, in Asia. Central banks will have bought it and stood for delivery, I'm sure, and so on and so forth.
China has systematically captured global gold market control through coordinated state and private sector accumulation. Alasdair Macleod's analysis shows China now dominates physical markets and actively challenges Western paper trading control. This transformation represents a fundamental shift in precious metals trading that has developed over the past 2 years through deliberate and calculated market positioning. The scale demonstrates precision execution that reflects sophisticated market understanding. The People's Bank of China bought 735 tons in 2023, two-thirds covertly to avoid price disruption. Private sector imports reached 1,411 tons in 2023, plus 228 tons in January 2024 alone. This dual approach maximizes accumulation while maintaining price stability, allowing China to build dominant positions without triggering competing purchases or regulatory intervention from Western authorities. China's infrastructure strategy extends beyond accumulation into comprehensive market restructuring. The Shanghai Gold Exchange is establishing overseas vaults in Hong Kong and Saudi Arabia, enabling yuan-denominated gold delivery internationally. Trading volumes increased 37% since 2022, positioning Shanghai as an alternative to London's LBMA and New York's COMEX. This infrastructure development creates practical alternatives to Western-controlled systems, while facilitating international trade settlements that bypass traditional dollar-denominated mechanisms. Let's get back to the video.
China really does control the physical gold market, and I think she's seeking to control the paper market as well, or take the control, if you like, away from the West. And there are very good reasons for doing this, and it's a policy which has just accelerated recently because her response to American trade sanctions has been very much to take the view, right, well, as I said, we've got to protect ourselves. It's really what they're saying. And so they've accelerated, trade relations and all the rest of it, diplomatic relations around the ASEAN nations, of which I think Singapore is one. They've said, and this is really, I think, preparation for the protection of the yuan. They've said, we will open gold vaults outside China. This is a completely new departure. And so far as I understand it, they've said they're opening one in Hong Kong and they're opening one in Saudi Arabia. Why Saudi Arabia? Because that's their biggest oil supplier. So, and I actually think it's demanded by the Saudis as well. So you can see that this is sort of going into place. Now, when it comes to the paper markets, they've also opened up the Shanghai Futures Exchange to foreign institutions. And that was announced, a couple of weeks ago. And it's not just gold and silver, it's also all metals. So that, a foreign bank, like, say, JP Morgan or whatever, doesn't have to set up a Chinese entity in order to deal on the futures exchange. It can deal direct, just as a Chinese bank can deal direct through Globex on COMEX. So, these are very, very important steps. It gets very little commentary, if you like, in the public arena, but I believe these are extremely important steps, and it shows a desire by the Chinese to get control over the gold market. And why do they want to do that? They want to do that to protect their own currency, because China knows that real money, as opposed to credit, is gold. And if you're going to have a fiat currency problem, then you have got to be able to protect the purchasing power of your currency. If you have gold, you don't want to go shouting and telling everybody about it. I mean, most of the gold in London vaults is really for foreign institutions, foreign high net worth individuals. What they're doing, Patrick, is they're just looking at, if you like, fiat currencies, and particularly the dollar. They're overweight dollar, and they're worried about being overweight dollar. So what the central banks have been doing is rebalancing their reserves away from fiat currencies towards gold, which is legal money. So, if you like, they see increased risk in the whole system. And you've only got to look at the debt situation. If you analyze the debt situation that America is in, that the UK is in, that France is in, that Spain's in, that Italy's in, and all the rest of it, basically, virtually all the members of the G7 are in debt traps, which basically means that the currencies are in a position where they're going to begin to destroy themselves if things go wrong. So do you really want to hold all those dollars? So central banks are tending to get out. And of course, this is being reflected in foreign holdings of US treasuries, for example. That's not really declining too much at the moment. I mean, one or two countries have been selling down their reserves. I mean, China, for example, you could argue that the reason they've been doing that is geopolitical rather than anything else. But, when the People's Bank goes out and buys gold, the way to look at it from their point of view is they're not buying gold, they're selling dollars.
Gold continues to gain strength as physical demand accelerates, particularly from China's central bank and private sector, shifting the market's center of gravity away from the West. With covert purchases, record imports, and strategic moves to internationalize its gold presence, China is positioning gold as a foundation for monetary stability. Is global gold dominance quietly changing hands? Let us know your thoughts in the comments below. If you found this video helpful, don't forget to like, share, and subscribe for more sharp insights into gold and the global economy. Stay informed, stay ahead, and thanks for watching.